Welcome to This Explainer. Picture this, a financial system where a traditional bank branch, the ones with marble floors and velvet ropes, is actually super rare. Instead, your everyday cell phone literally holds the entire economy together. Well, that's exactly the reality in Zambia right now. Today, we're diving into a fascinating tug-of-war happening in Zambia's economic policy. On one hand, we've got the incredible, transformative power of mobile money, a tool that's quite literally pulling millions out of financial isolation. But on the flip side, the government has a very real, pressing need to generate domestic tax revenue to keep the lights on. So we're going to look at exactly what happens when these two massive forces collide.
Okay, let's map out our journey for today. We're going to start by looking at Zambia's mobile money boom. Then we'll cover remittances and rural migration, followed by the new transaction tax, the regressive tax trap, and finally, a progressive path forward.
Section 1. Zambia's mobile money boom. So, if you walk down almost any street in Zambia, you're going to see this incredibly vibrant network of bright mobile money booths. Honestly, these kiosks are the vital arteries keeping the whole economy pumping. Just think of them as the ATM, the local bank teller, and an international wire transfer service all rolled into one right there on the street corner. For a developing economy, this kind of decentralized infrastructure is an absolute game changer. Why? Because it adapts to where people actually are, rather than forcing them to adapt to the banks. And the reason these booths are literally everywhere really just boils down to pure convenience and necessity. Look at this. Mobile money usage among adults is sitting at a massive 58.5%. That is nearly triple the rate of formal banking. And the reason for that is pretty simple. Over half the population can walk to one of these agents in under 30 minutes. Now think about what that means if you live in a rural area. A traditional brick-and-mortar bank, that might be a multi-hour or even multi-day journey away. In that context, mobile money isn't just some convenient alternative. It's often the only viable way to safely store and move your funds. Because of that widespread, immediate access, Zambia is really banking on this network to hit its national financial inclusion strategy target. They're aiming for 85% inclusion by 2028. And hitting this target isn't just about making government spreadsheets look good, it is the literal difference between a marginalized rural farmer being permanently locked out of the global economy versus being empowered to actually save, invest, and build generational wealth securely. For sure, mobile money is the absolute cornerstone of bringing women and rural populations into the formal financial fold. All right, moving on to Section 2, remittances and rural migration. The sheer volume of money flowing through these booths is just staggering. According to the Bank of Zambia, internal remittances on these mobile platforms hit $14.1 billion in 2023. Let's just pause for a second and put that massive number into perspective. Okay, that is over half of Zambia's entire gross domestic product, just flowing silently between cell phones. I mean, think about the economic velocity that creates. It represents millions of microtransactions, small business deals, and families supporting each other at lightning speed. These digital remittances act as a really crucial safety net. Say there's a localized crisis like a drought or a flood, an immediate cash injection sent from a relative in a less affected area can severely reduce food insecurity. But crucially, it also changes human behavior. Instead of relying on traditional, formal insurance, communities often create informal group insurance schemes. They basically pool their money to help a family member move to the city. And they do this knowing with absolute certainty that this person can instantly beam their urban earnings back to the village. This kind of digital risk sharing dramatically lowers the financial and psychological costs of migration. And when we look at the data from the 2022 Labor Force Survey, a really fascinating behavioral trend emerges. Get this. Daily mobile money users are over 4 times more likely to have recently migrated between districts compared to non-users. Now, here is why that matters. Agriculture accounts for about 59% of employment in Zambia, but only 3.4% of the GDP. Mobile money actively incentivizes people to take a calculated risk. It provides that financial tether a farmer needs to leave low-yield agriculture, head out to seek much more productive urban jobs, and know securely that they can instantly support the family they left behind. Which brings us to Section 3, the new transaction tax. So, what happens when the ultimate tool for poverty reduction catches the eye of the taxman? Well, like any developing nation, Zambia faces very genuine challenges with infrastructure development, public services, and national budget deficits. And, governments understandably have to look for domestic revenue where the money is actively flowing. Seeking to boost this revenue, the government enacted the Mobile Money Transaction Levy Act, number 25 of 2024. Basically, this policy introduces a new tax on mobile money transfers.
That means users now have to pay a direct additional fee to the Zambia Revenue Authority every single time they move money.
When we break down the actual fee structure from the 2024 Act, a distinct source of friction becomes immediately apparent. The tax ranges from 0.04% to 0.21% of the transfer value. But listen to how this is distributed. It's actually kind of wild. The tax percentage is at its highest for the lowest transaction amounts. It sits at a maximum of 0.21% for small, everyday transfers, anything between 1 and 150 kwacha. Conversely, the rate drops all the way down to just 0.04% for the absolute largest transfers, those above 10,000 kwacha. This brings us to Section 4, the regressive tax trap. This specific fee structure inadvertently introduces a pretty major economic conflict. To understand the real-world impact here, imagine two very different consumers. On one side, you have a low-income consumer who has to buy their vegetables and daily market supplies in small 50 kwacha increments. Why? Because they don't have a refrigerator or the cash reserves to buy in advance. On the other side, you have a wealthier consumer who can easily afford to drive to a supermarket and buy that exact same total amount of supplies in a single, massive monthly bulk transaction. Well, because of how these tax brackets are structured, that poorer consumer, the one forced by their circumstances to make multiple small daily transactions, ends up paying 3 times more tax over the course of the month than the wealthy bulk buyer. The fee ratio is entirely bottom-heavy. This creates a classic regressive tax trap, inadvertently penalizing the most economically vulnerable users. And honestly, the grand irony here is that this policy financially punishes the exact same demographic that the National Financial Inclusion Strategy is desperately trying to onboard. But, people are incredibly resourceful, especially when it comes to avoiding fees. Early 2025 data from the Bank of Zambia shows that while mobile money transaction volumes rose modestly by 14%, the actual monetary value of those transactions skyrocketed by nearly 128%. Users are essentially acting as their own informal banks now. They are actively pooling their money, waiting to send one massive lump sum rather than a dozen small ones. They're completely changing their consumption patterns just to dodge that heavier tax bite on small transfers. However, the good news for the overall economic resilience of this system is that, despite the new levy, nearly 90% of current users still perceive mobile money as cheap or very cheap. But we need to keep in mind, cheap is a highly relative term here. They're absorbing the cost not because the tax is perfectly fine, but because the alternative, like taking a day-long physical bus ride to hand-deliver cash to a rural village, is vastly more expensive in both time and money. Demand won't collapse simply because there's just no other viable option. Finally, let's look at Section 5, a progressive path forward. So how exactly do policymakers balance this entirely legitimate need to fund the government without crushing the poorest users and undoing years of financial inclusion? Well, the International Growth Center suggests a very practical policy pivot. Flip the structure. By revising the levy into a progressive system, the government can protect small, daily transfers and logically shift the tax weight to larger, higher-income transfers. They also warn policymakers to resist the urge for across-the-board fee increases and to preserve the current modest 0.21% maximum tax band so it doesn't stifle the economy. And lastly, they urge government institutions to rigorously use transaction microdata to monitor exactly how these fees are shifting user behavior on the ground. As we wrap up this explainer, the tug-of-war continues. And we're really left to wonder, is this new transaction levy going to create a permanent roadblock for Zambia's ambitious 85% financial inclusion target? Or will their future policy adjustments pave the way for a revolutionary, progressive tax model? Make no mistake, the rest of the developing world is watching this experiment very closely. The balance Zambia strikes here could absolutely write the fundamental blueprint for the future of mobile money, taxation, and financial equity across the entire African continent.